Welcome to J2 Global's second fiscal quarter investors presentation. Before we begin, on slide 2, you'll see the safe harbor for forward-looking statements, as this presentation will address guidance for fiscal year 2013 as well as other forward-looking statements. Slide 3, we outline some of the risk factors that might cause such results to differ from our anticipated results, and I will also draw your attention to the various SEC filings we have, such as our Form 10-K, various Form 10-Qs, and proxy statements. On page 4, we begin to look at the financial highlights for the second fiscal quarter, the best in the company's history. It was a record quarter for revenues, gross profit, EBITDA, lowest cancel rate in the company's history, as well as the largest contribution from our intellectual and licensing efforts. Slide 5 breaks out the various contributions. For the quarter, on a non-GAAP basis, we had approximately $94 million of cloud subscription-based revenue, $15 million of licensing revenue, of which $12.6 million relates to the earlier settlement in April of $27 million, of which $12.6 million was recorded as past damages and booked in the quarter, and the remaining $14.4 million will be amortized into revenue between now and June of 2018. And then our new media business did $31.2 million of non-GAAP revenue for total revenues of the company of $140 million. Our EBITDA for the cloud business, inclusive of licensing, was $61.7 million, a record both in terms of aggregate dollars as well as in margin. The media business produced $4.7 million of EBITDA, or a 15% EBITDA margin, slightly in excess of its results for Q1. And as we remind you, the media business is very seasonal, with up to 35% of its revenues and 50% of its EBITDA occurring in the fourth fiscal quarter. Total EBITDA for the company was $66.4 million for the quarter. We had $9.5 million of depreciation and amortization expense, as well as $4.8 million of net interest expense, resulting in pre-tax income of $52.1 million, taxes of $13.5 million for GAAP net income or non-GAAP net income of $38.7 million, or 83 cents per fully diluted share. Slide 6 begins the discussion of our business cloud services. One of the key drivers of our cloud subscription business has been our eFax corporate solution. You will see that it has grown year-to-date 9% versus the prior year, both in revenues and 8% in terms of total DIDs or phone numbers, exiting the quarter with approximately 625,000 of our approximately 1.8 million fax DIDs being in the corporate space. 500 new accounts were added in Q2, and 875 accounts added in the first half of this year. 34 of those 500 accounts are enterprise, meaning they're contract-based, up 100% over the previous fiscal year. These customers are higher touch, longer relationship-oriented, and have a high ARPU per account in excess of $500 a month. They also have the lowest churn of any of our subscription-based customers. The chart below shows you, since we began serious efforts to go after the corporate customer in the fax space, how the revenues have trended through 2012 and the current run rate for 2013. You'll see that revenues in this time frame have increased 2.5 times, or on slightly in excess of 14% compound annual growth rate. If you go to slide 8, another key driver for our business cloud services has been decreasing cancel rate. This chart shows from 2009 through the present each of the 4 fiscal quarters, and you can see that in 2009, towards the tail end of the recession, our cancel rate for our fax and voice business was 3.3 percentage points per month. That has now dropped to a record low of 2.21%, or a 33% decline over the 4-year period. This is very important as it extends the lifetime value of our customers and is very helpful in terms of the overall profit profile for our fax and voice customers. The cancel rate has improved over the 4-year period through a combination of an improvement in the overall economy, as well as internal efforts through our customer service department and greater insights into overall credit card billing, all of which have resulted cumulatively in this improvement. Finally, on slide 9, we'd like to take one of the non-DID-based businesses and highlight it this quarter, specifically our online backup under the brand Keep It Safe. As you can see, revenues have grown dramatically, increasing 52% just from Q1 of 2013, now approaching a $10 million run rate. We've completed the integration of Backup Connect, which is our Netherlands-based asset. We've launched 24/7 customer support and have added another NFL football team to our portfolio. We welcome the Carolina Panthers. Now I'd like to turn our attention to our digital media business. As you may know, we hosted a Media Analyst Day on July 9th of this year and spent over 2 hours with an in-depth discussion about our digital media business, the opportunity, and the specific assets that we own. And I would encourage you to go and access that transcript to learn more about it. I'll spend a very short amount of time, though, to try to summarize the highlights from that media day. On slide 11, one of our objectives is to create leading properties in the verticals in which we participate. We currently participate in 3 verticals: tech reviews, games, and men's lifestyle. The metrics you see below are based on independent verification from Comscore, who, much like Nielsen, tracks page views and visitors for internet-based properties. You will see that through a combination of our Ziff Davis and NetShelter acquisition, we've now been able to surpass CNET in terms of our total monthly unique visitors for the month of June exceeding 30 million. In games, we run neck and neck with GameZone Group, some months in the number 1 position, some months in the number 2 position, still a very strong leader with a clout score of 99 out of 100, meaning that we're a strong influencer in that space. And men's lifestyle also number 1 with Ask Men. This is important for a couple of reasons. As advertisers look to spend their money, they will gravitate towards those who have the strongest reach in each of the verticals in which they wish to advertise. It also allows us the opportunity to offer unique bundles to those advertisers across several verticals. You will see that this is a cornerstone of our overall strategy as we go forward and we look both to add additional properties into these verticals, as well as contemplate adding additional verticals under our digital media business. Slide 12 gives you some updated highlights on where our business stands in the aggregate. As I mentioned, we acquired NetShelter in mid-May of 2013, have folded it into our Ziff Davis property, which now makes Ziff Davis the number 1 property in technology. Second is that we have substantially completed the integration of IGN into Ziff Davis. We do have one important piece that is ongoing, which is to complete the implementation of our video and display campaign management and ad serving technology. All of our properties combined now exceed 700 million page views across both our owned and operated properties of Ziff Davis and IGN, as well as our managed properties under NetShelter. Finally, let's look to our financial outlook. On slide 14, we are reaffirming the guidance that we issued last quarter, which was a raise from the quarter before, and we expect revenues for the full fiscal year 2013 to be between $510 million and $535 million, and our non-GAAP EPS to be between $2.78 per share and $2.98 per share. Not included in non-GAAP EPS is share-based compensation expense and approximately $4 million of integration and exit costs related to IGN. We also assume a tax rate of between 25% and 27% for the full fiscal year. Finally, On slide 15 and following are a number of supplemental schedules which outline the metrics for both the cloud business, the media business, as well as J2 Global Consolidated, and various reconciling statements between the various non-GAAP measures used in the presentation and its nearest GAAP equivalent. Thank you.